Okay. So there's a lot of, okay, there's a lot of hands popping up there with ideas popping up, with companies being founded this year, this calendar year. This is great. This is great. Now, the last question that I have for you guys is those that are looking to actually launch your company this year, do you already have a product built? Do you have a storefront? What is it? Do you already have a product built? Are you still even in the building phase? Show of hands if you're still in the building phase. Building phase. Okay. 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 Some have a mobile app. Damien is a mobile app. Now, Damien, have you already launched your product yet, or you still haven't launched just yet? Damien, can you hear me? If you could just kind of quickly tell us,
Yeah,
that
yeah.
would be helpful.
Um,
MVP.
yeah, I was just writing. So I developed a mobile app. I put that on the market, and now I'm monetizing that. I'm just starting this week. So when I will have done that, after I will open a company, but not before. But the project is ready and already on the market.
Okay, good, good. That's fantastic. That's good. So sounds like to me we are all at Pablo. Where are you? Do you already have a product? Pablo Hernandez, do you already have a product? Or is just MVP still? What stage are you?
Hi. We are building the product, so we still don't have the product. We are just getting some hypotheses and yeah, building in the discovery phase.
Discovery phase. So you're looking maybe to have something maybe by end of this year?
I think so. Yeah, should be. Yeah, if everything goes well.
Okay. Okay, that's good. All right. So this is fantastic. I have a mobile app. Let me see here. It says I have a mobile app already in the market. Quaish? Did I say it right? Quaish? So you already have a mobile app in the market, right? Can you tell us about the app and what it does, Quaish? If you could just unmute yourself and tell us what your mobile app does. Okay. Hyperlocal app delivering essentials. Okay, hyperlocal app delivering essentials. Okay, fantastic. That's great. So sounds like we're kind of all over the map in terms of where we are with our businesses. Either we've built product, we're building product, some are in the market already, and starting that process of engaging customers. So this is great. So here's the thing. We have a session that's coming up in February around value proposition. This is really around storytelling. How do you tell your customers what you're selling, what you have, and why should they care? This is really focused around a compelling story, why customers should care for your product, right? So again, that's another session coming in February. If that's of interest to you, or if you know anybody that would be interested in that type of session, I've just dropped the link for you guys down in the chat. So you can use that to register for that session that's upcoming again. It's on value proposition, which is really storytelling. Why should customers care for your product, right? You have to really have that dialed in and have a compelling story why they should care. When you're thinking about why customers should care for your product, you're really thinking about people outside of your friends, of mom and dad, of your brother and sister, your nieces and nephews, right? It's really people you don't know that will interact and engage with your product and will actually write a check, swipe their credit card. That shows you that they care for the problem that you're solving. It's a powerful session that we have coming up in February. So there's a link. Go out and register for that session, okay? All right. So now let's jump right into the mission for today, which is really around financial modeling or revenue modeling. Okay. This is absolutely critical in your fundraising process, but also it helps you understand your business even better. Okay. Your revenue modeling and financial modeling, those two work hand in hand. It really helps you understand your business better. But also, as you start to go out in the market to try and raise capital, this becomes absolutely critical for you to really have your head around what your revenue model looks like, what your financial model looks like, because that is what investors are going to be asking for. Even if you're just early on with just an MVP, pre-product, pre-seed, right? You still have to have a good articulation around how you're going to make money. That's what it's about. At the end of the day, as you engage with investors or anybody you're looking to put money into your organization, they want to know, how do you plan on making money within your organization? Okay? How do you plan on making money with your product? You may not plan on raising capital, which is fine, but you need to be able to understand, as a business owner, as an operator, you need to be able to understand how your business makes money. That's what we're going to spend the next 45 minutes really talking about. How you make money in your business. And for you to really have a good understanding around your little widget that you have, your software that you have, and how that software actually returns a profit. That's what we spend time on. And again, I want to make this session as interactive as possible. So please don't hesitate to ask questions. Come in the room and ask as many questions as possible. So I want to make sure that when you leave today, you actually have practical things that you can put your hands on to really help you move forward with putting together a very nice and compelling revenue model or financial model to really help and show others how you're going to make money and help you understand how you're going to make money. Now, as you know, if you're going to be targeting any investor to raise capital, the ideal investor profile becomes absolutely critical. What does that mean? You want to target investors that have an interest in what you're building and what you're creating. That's who you want to target. You want to spend time with people that have an interest in your product, in the solution that you're bringing to the market at the stage of your business, because not every investor is for everybody. So as you're doing your campaign for fundraising, identifying that ideal investor profile becomes absolutely critical in your process. So you want to make sure that you really have your hand around that. Tools like Raise can help you with identifying what the ideal investor profile is. And then you start your fundraising process, your outreach process, just like you would run your sales process, right? You're constantly marketing out your company, reaching out to investors and sending out emails to get connections, and sometimes looking them up on LinkedIn to see if maybe you have a mutual connection for a warm introduction. So tools like Raise is going to help you really narrow down on that investor profile to really help drive that piece of it. Okay, so it's important. These are the people that you would then share with your financial models, your revenue models. Okay, now we have also coming up in March our pitch competition. The pitch competition is going to focus on 2 stages of the company. So pre-seed, that means anybody with maybe just an idea, pre-product, they're still building, they don't have any revenue, they don't have any customers. Those are what are called pre-seed companies. It's very early on. You even maybe haven't validated the problem in the market. So it's focused on pre-seed companies and seed companies. Seed companies may already have a product, trying to get in the market, may have 1 or 2 customers, and they're trying to validate that. Those are seed companies. Some seed companies already have revenue, so they are maybe ahead of others. So we have a pitch competition this March, in 2 months, where people will be winning non-dilutive funding. This is money you get for free with no strings attached, up to $15,000. Okay, that will be given out on this day in March. So here in the next week, we'll be announcing our top 100 companies that have moved on to quarterfinals. Okay, and of those top 100 companies, some of them will move directly to our annual competition this summer, where we will invest over $150,000 to a company. This is actually an investment on a safe note, what's called a YC safe. Okay, so we have a pitch competition this quarter coming up in March, and one later this year in the late summertime into the fall. Okay, where again people will be having an opportunity to get some capital. Again, pre-seed and seed companies. So most of you here would qualify. If that's of interest to you, you may not be interested, and that's fine, okay? So if you go on our website, you should be able to see that. Again, our website is raisecap.com. Okay, looks like we have a question in the chat. Damien, can you come on screen and ask us the question? Question I think says, how do I find investors specialized in myself? What is in the, when it's not fintech, not medtech? Damien, is that your question?
Yeah, it's my question.
So your question is, what do you do, Damien? Tell me more about your company.
I developed a mobile app that helps parents to find activities to do with their kids. So about the monetization, in fact, I will ask to the professional that propose activities to pay me a subscription so that I display their activities in my mobile app to bring them more visibility. So
Okay.
if I want to find an investor, I don't know what kind of specialized investor I should find.
So the first thing you want to do is you want to define the business that you're in. So you've developed a mobile app for kids, is that correct?
Yeah, it's more for help parents to find activities. I mean that the parents haven't need to go on internet and pass a lot of time to find activities to do with our kids. But in fact,
Oh, I
the
got you.
global project will be for the world and for everybody, not only for family.
Okay. So it sounds like it's a platform where if you want to find an activity around you, you can go in there and identify your interest. Then it recommends and suggests different activities around you that you can engage in. Is that correct?
Yeah, it's exactly that. And I would like also to precise that it's activity, like for example, cinema, bowling, paintball, karting, all these kind of things. It's not event, it's not touristic things. It's only activities that you can do during all the year.
Okay, fantastic. So one of the things, so it's a mobile app, right? That has an e-commerce built in. So sounds like it's like a Yelp or an Open Table to some degree, right? So you want to define what that is. So it's a B2C software application, right?
Yeah, it's a kind of SaaS because it's a subscription, but at the same time, it's a marketplace because it's professional that will
It-
complete, for example, a form for
right.
that automatically display on the mobile app their activities.
That's fantastic. So here's what you want to do when you go into your race profile. When it says industry, I want you to tag software. I want you to tag SaaS. I want you to tag marketplace. I want you to tag subscription. There's no subscription, but SaaS, marketplace, B2B software, and B2C.
Yeah, okay.
When you do that, it's going to narrow down, and also tag fintech.
Okay.
Okay. Tag those as your industry. It's going to narrow down all the investors in that space at your stage. And also tag, because you're pre-seed, is that correct, or your seed?
I think I'm between the both because I already have a mobile app on the market, but I just need to monetize that, and I'm just doing that now.
So let's tag it as pre-seed, okay? When you
Okay.
tag it as pre-seed, then it's going to narrow down and aggregate for you and identify investors within that space, and it will give you a percentage score of your raise match. Those are the investors you want to reach out to.
Okay.
Right now, investors are starting to write checks. They're back from the holidays. They're starting to write checks right now. They're starting to take meetings. So they're active right now, and the market is up.
Okay.
Okay.
Yeah.
Can cold emails effectively, Kawish, can you come on screen and tell us what your question is? Kawish, is that right? Did I say? I hope I said that name right. Kawish Aurora. Here's the question. It says, can cold emails effectively generate leads when reaching out to potential investors? Here's the thing, Kawish, unless you really have connections for warm introductions, cold emails become an option that you have, right? You want to cast out a wide net as wide as possible, because right now, nobody knows about your company. Nobody knows about what you're building. How do you get the word out? How do you get investors to know about what you're building, right? So you have to take a proactive approach of getting your word out, talking about what you're building on your social platforms, and even cold outreach, right? It's like sales. Think about sales and marketing, right? When you're doing a sales campaign, you just reach out to as many potential leads as possible, and one will bite, one will respond. When that one responds and you have an opportunity for a meeting, after every investor meeting, you want to ask for, do you know anybody else that may be interested in what we're building? They will give you an introduction to a warm lead. So obviously cold calling, cold emails are not as effective as warm intros. But when you don't have warm intros, what do? You don't want to just sit back and relax and hope they find you. You want to take an action and proactively engage and reach out to investors. That's where tools like Raise become powerful, because we have investors in the platform that are already looking at your profile. You want to make sure that your profile is 100% complete. That way they see exactly what you're building, what you're creating, and the reaching out begins. Now we're just beginning the investor season. The election is over, the beginning of the year, everybody's excited. There's a lot of dry powder out there, and investors are starting to really engage in meetings and meeting with folks. So you want to be ready and you want to be prepared for that. Hopefully, Kawish, that answers your question, okay? All right, let's move on. So there you go. And again, the pitch competition will give you visibility to a lot of investors that will be in the room. So that'll provide you an opportunity as well to be in front of investors that will be in the room. Okay, let's move on, right? So one of the things we're talking about today around financial modeling, I want you to think about 3 different buckets, okay? Number 1 is decision-making. Number 2 is fundraising. And number 3 is strategic planning. These are the 3 big buckets that your revenue model and your financial model will help you in decision-making around these pieces. How are you going to grow the business? How are you going to break even? What is your fundraising strategy? I'm running out of money right now. What do I need to do? My sales are not coming in. All these things will be part of your revenue model and really helping you understand your business and what you're trying to do. So what we'll do today is we'll cover the key fundamentals of understanding the revenue model and financial modeling. So we'll talk about that. The second piece we'll talk about is revenue modeling for startups. Whether you are a software company or you actually have an actual product with the software, or you have a storefront, or you're selling a widget. Maybe there's a device you actually have created and you're selling that widget. What does that look like and what does that mean? We'll take a look at the key definitions. You'll hear things like ARR, CTV, LTV, MRR. I'm sure you've heard all those acronyms and you're going, oh my gosh, what are they talking about? They're speaking of a different language. Well, today we'll be able to unpack all of those key ones for you so you have a basic understanding of what these acronyms mean for your specific business. We'll talk about that. And then at the end of this, we'll actually do an exercise and we'll show you guys an example of what the output should look like. So let's jump right into it. Are you going to share this presentation? Pablo, absolutely. We will share the presentation with whomever wants the presentation, okay? So you can send us an email at support@raisecap.com. Support@raisecap.com. So if anybody wants the presentation, we will share with you. Send us an email and let us know that you want the presentation. And also note, this video will be posted on our YouTube channel. So you also have an opportunity to go on the YouTube channel and watch the video in its entirety. Okay, so here are the key 4 buckets we need to think about when you talks about KPIs. And KPI, do you guys know what KPI stands for? Anybody? KPI, do you guys know what KPI stands for? I want to hear from somebody. Does anybody come on the screen and tell us what KPI stands for?
Yes,
But
yes, it is key performance indicators.
that is correct, Samath. Key performance indicators. Now, Samath, tell us, what do you do? What's your business?
Yeah, so for me, I want to plan a startup which is based on AI and climate change, actually. So for me, so it's for that HVAC systems. If I can make them sense through AI, so once they can sense that, so if the tenancy is less probably, or when it's time for heat, then that will do it by itself, or when it is time for cold. So
Mhm.
so the planning and all those things for the HVAC systems, that will be done by AI and some kind of laws from the physics as well. So those will be merged, and then we will use that. So that is my concept that I have for the timing. I mean, I want to grow on that.
That's good. That's fantastic. So you want to work with the HVAC systems and put some type of AI modeling in those so they can sense the different temperatures and automate the turning on heat, turning off heat, all that good stuff, correct?
Exactly, exactly.
Oh, fantastic. That's good. Congratulations, man. Again, the first step is thinking about the idea. The second step is what? Taking action. You've got
Yes.
to take action. Now, on the taking action, guys, I want to remind you this. You will see this in the presentation. You have to move fast. You have to move fast. Take an action, move fast. Move fast, move fast, move fast. Okay. So here are the 4 buckets we're looking at. Your financial KPIs, okay? Customer KPIs, your product and operational KPIs, sales and marketing KPIs. These are 4 of the most critical KPIs that any investor that you engage with will be looking at. They want to understand your financial KPIs, your customer KPIs, your product and operational KPIs, and your sales and marketing KPIs. Even if you don't engage investors, if you have a good understanding of these KPIs, you have a good understanding of your business. And that's what you really want to have, a better understanding of your business, how your business works, and what levers to pull or push to make your business go to the next level. This will help you with that. Okay? So let's take a look at the financial KPIs. All right. You have your revenue growth. Revenue growth, what you're looking at is you're really looking at the growth rate over a period of time. Some will say, what's your monthly year-on-year growth? Some will ask for month-to-month growth, year-to-year growth, quarter-to-quarter growth. You want to see a change and a shift that is positive in your revenue growth. So if last month you did $20, next month, ideally, you want to do at least $21. That shows the change and the shift in the revenue from the month before to the current month to the next month. That way, after 3, 6, 12 months, you're able to really take that and project what the next year is going to look like. So you want to be able to have your revenue growth rate and understand what the growth rate is, because you can then take that number, extrapolate that for the next year. Okay? You want to understand your customer acquisition cost. That's an important one, because your customer acquisition cost tells you really how much you should sell your product for, how much your subscription should be for, how much you charge for your services. So you really want to understand how much it costs you to acquire a customer, whether you're getting those customers through Facebook, through LinkedIn, or if you have a retail store and they're coming into your store, you have to take a look at how much rent are you paying for that retail location to bring those customers in, then aggregate that and divide that rent over time with the number of customers that came in. That gives you your customer acquisition cost. If you're marketing on Facebook or Google or Meta or LinkedIn, you want to understand how much is it costing you to market on those platforms and how many customers you're getting back. So you take the total cost of the cost on the marketing you've done, divided by the number of customers that you actually get back. That will give you your customer acquisition cost. Your burn rate. This is how much money you're burning through each month. How much money are you spending each month? This becomes critical for you because you need to understand how much runway you have. So if you have $100,000 in the bank right now, and you're burning through $10,000 a month, how much runway do you have? That's a question for the group. If you have $100,000 in the bank right now, and you're burning through $10,000 a month, how much runway do you have? 10 months. Asaf say 10 months. Asaf, how did you come up with that number? If you come on screen and tell us how you came up with that number.
I divided the 100,000 for 10,000 burn rate of each month.
Fantastic. Investors are going to ask you that question. They're going to say, how much runway do you have? Which is your burn rate. So you would then say, when they say how much runway do you have, they're actually looking for the number of months. So in this example I just gave, you would say 10 months. So then that tells them, okay, and they'll say, what's your burn rate? Your burn rate is how much money are you spending each month? So they understand, okay, so you have $100,000 in the bank. So that's important. Your lifetime value, LTV. What that means is after a customer buys from you the first time, do they come back after that one time? So what you want to do is if a customer comes to you and they buy your product for $100, and then they come the next month for another 100, they come for the next month for another 100, and next month for another 100, that's 4 months. They've just spent $400 with you, and then they fall off. Over time, you want to aggregate your total customers and how long they stayed with you. That's your lifetime value. Ideally, you want to make sure that your customer acquisition cost is lower than your lifetime value of your customer. I want to say this one more time. You want to make sure that your customer acquisition cost, which is your CAC, is lower than your LTV, which is your lifetime value of your customer. Why is that important? Because if your CAC is higher than your lifetime value of your customer, that means your business is not making money or does not have the potential to make money. So you really want to keep an eye on those numbers, okay? So gross margin, you want to make sure that on every customer you retain, you're making profit after you take a look at the cost of goods sold. There's enough margin in there for you to do other things. So you're making a profit. Runway is what we already talked about with the burn rate. So let's move on. The next bucket is your customer KPIs. Again, investors would want to understand this piece, okay? What is your retention rate? What does that mean, retention rate? Do anybody know what retention rate means? The number of customers that actually are staying with you over a period of time. How many of those are coming back? It's important. Now, here's another one you want to do once you start having customers, what's called a net promoter score. It really gauges how satisfied your customers are with your product offering. This is important because it helps drive what are called network effects or recommendations. If you have a high net promoter score, what that tells you is your customers are actually going to tell other people about your product, which then drives your customer acquisition cost, which then drives your retention rate, which then drives your gross margins. So investors will like that business. And I'm sure too, for you as an operator and a founder, you will love the business as well, because that tells you your customers love you. Your churn rate is the percentage of customers that stop using your product within a specific period of time. They're dropping off. So if you're bringing 100 customers a month, and by the end of next month, you're only down to 95 customers, what's your churn rate? 5. You're losing 5 customers a month. That's your churn rate. But if you're losing 100 customers a month that you brought back on, whoo, Lord, your business is not going to survive because you're losing every customer that you're bringing on. It's costing you so much money and your lifetime value is not where it needs to be, and you will most likely not survive. So you really have to make some changes, some tweaks and adjustments within your business to really help you move forward. I'll stop there for now and say questions, comments. All right. So Matt, question. Go
Yeah,
ahead.
so I have a doubt that if the churn rate and the customer growth rate both are high, then I am growing or not growing? I mean,
So you just have to look at the actual numbers, right?
okay,
Because what you will have to really understand is why are they dropping off?
okay,
That's important, right? So what that tells me, if you have a high growth rate and high churn rate, right? That tells me your value proposition is very, very strong. So you really are trying to solve a big enough problem that they're excited to come and pay for the product. But the reason why they're not staying is they're feeling like they got sold a bag of goods.
okay.
They're not getting the actual value that they were expecting. So you need to
Absolutely.
make some changes and some tweaks. Okay.
Okay,
So
absolutely. Thank you.
you are onto something because
Yeah,
they're coming on, but they're dropping off. Let's find a way to keep them. How do we keep them? So you have to make some changes, some tweaks.
yeah, absolutely. Thank you.
Any other question? Just unmute yourself and come on. You don't need to raise your hand. All right. If no questions, let's move on to the next bucket. Your product / operational KPIs. This is very, very important, right? So Damon, I'm going to use you as an example. You have the first one, it's around product usage matrix. After users have signed on your platform, how long are they using your platform for? How many minutes a day? How many active users do you have a day? How often do they use the platform over a period of a month, over 6 months? This is very important to really understand what's called the stickiness of your solution. I'm sure you've heard of the stickiness of your solution. Is it sticky enough to where it brings them back all the time? For example, if you look at Facebook, right, or any social media, TikTok, here's a good example, TikTok. People are constantly going back on TikTok and using it. It's highly sticky. So they'll talk about daily active use of 170 million users a day. 100, that's a highly engaging application. So you want to take a look at that. If you have a software application, you want to take a look at the feature adoption rate. Anytime you push out a new feature, how effectively is it and how often is it being used? Here's what I talked about when I said you need to move fast. Investors are always looking for this. How fast do you ship out ideas? Which is time to market. Because this measures your efficiency, right? It's important for you because if you're taking too long to push out a feature, that means the cost of that feature is going up. You want to make sure you maintain the cost all the way down and push out many features as quickly and as fast as possible. So your time to market has to be on point. And the last one is your support response time to your customers. Your customers need to know that you're there to help them solve this problem that they're trying to solve. Let me tell you something. Even when your product does not work the way it's supposed to be, when customers know that you are responsive and you care, they are more gracious with you to give you the time you need to fix it. But you have to be responsive. You have to be responsive. When you're not responsive, customers then give up on you and they move on, and you lose customers and you lose the momentum you need, and you eventually go out of business. And you don't want that. So you want to be super responsive, and you want to push out and ship out product as fast as possible. Do not take too long thinking about it and trying to build a perfect solution. Perfection is the killer of progress. Anytime you have a solution, an idea, you need to find a way to quickly push it out in the market and test it, and iterate. It does not have to be perfect. Just push it out in the market and test it and iterate. It's an iterative process, okay? So do not hesitate and feel bad that it's not working. I mean, iPhone just pushed out their AI agency intelligence and it didn't work. You guys saw that. Everybody, the whole world saw that. But nobody really cares because they took it back and they're fixing it. They're going to push it out again. It's the same thing with you guys, with us, as we're building solutions and products. Any questions, comments? All right. Sales and marketing KPIs. This becomes absolutely critical when you have some type of revenue coming in, right? Because before you have revenue, it's a bunch of assumptions, it's a bunch of spreadsheets with some crazy hockey stick graphs that nobody works, that don't work, they don't mean anything to anybody, right? Until you start making revenue and you have revenue coming in, your sales and marketing KPIs become absolutely critical in your revenue and financial model. So number one, your sales pipeline value. If you're selling an enterprise solution, what you want to know is, how much do I have in my pipeline to work on and to close? Now, why is this important? This is just like investor outreach. If you're going to raise right now, you should be able to go to your search, find an investor, and add that investor into your pipeline. Then when you reach out to them, you know who you reached out to, and you start managing the pipeline. Sending them one request and expecting them to respond back is just not going to happen. Okay? It's just like sales. You have to build what's called top of the funnel. And on top of the funnel, you want to include as many prospects as possible, because not all of them are going to close. Same thing within raising capital. You want to reach out to as many investors as possible, because none of them are going to give you money. I'm going to remind you one thing, guys. You can look this up. Amazon, Jeff Bezos reached out to over 100 investors before he got his first check for $50,000. I want you to think about that. This is Amazon, AWS, what we use every day. Jeff Bezos reached out to over 100 investors before he got his first check for $50,000. So why should you give up? Just like sales. If you're trying to sell the product, you're trying to get out in the market, you need to make sure that you're reaching out to as many people as possible, telling them about what you're doing and showing them your product. That pipeline has to be big enough to show volume and what the value is. Then after you've identified what the lead is, you want to take a look at, from the top of the funnel, what is the conversion rate to becoming a deal? If you have 100 leads in the pipeline, in the funnel, and then 20 close, what's your conversion rate? That's a question for the group. I want to hear a response on that. If you have 100 leads in the funnel and 20 of them convert, what's the percentage of conversion rate? Pablo says 20. Is it 20 or 80? I'm asking the group. Is it 20 or 80? 1 to 5, there you go. So it is 20%. It is absolutely 20%. So 20% is your conversion rate. So you want to make sure you understand what the lead to conversion rate is, okay, for your paying customers. Now, any marketing you're doing, whether you're doing it on Facebook, Instagram, Meta, wherever you're putting marketing on, you want to make sure that you measure marketing this way, okay? You want to write this down. Some of you already know this, but this is an important metric, right? You take a look at the cost, the total cost of marketing dollars deployed. So if we deploy $10,000 for marketing, okay, and of that marketing, we get 100 leads. So that's $10,000 and we get 100 leads. That means how much is each lead? $10,000 on marketing and we get 100 leads. That means $100. Oh, okay. There's different answers there. I want to see this. This is interesting. Damien says $10. Somebody says 100. So what is the answer? Somebody says 1%. 100. You've spent $10,000 on marketing. Of that $10,000, you've actually gotten 100 leads. $100. It's 100. Okay. Now, what you then look at is, out of those 100, how many of them actually became customers, which is 20%, which we talked about. So you use those metrics to really understand, very expensive, right? But now it depends with how much your product is and what your lifetime value is. You see that, Asaf? So it may sound expensive, but you then have to look at your LTV, your lifetime value over time. How much is your lifetime value on these customers? Because they may be paying for themselves 10, 15, 20, 10 times over. So at the end of the day, it's really not expensive. So for example, we have a software that costs $33,000, but it cost us $5,000 to get a customer. So when you look at the cost of acquisition, it's $5,000. That's a big number. But if that converts over to becoming a deal, that's $33,000 for one time. But then the lifetime value is 6. So that's 33 times 6. So should I spend the $5,000 or not? Yes or no? If you're spending, yes. Pablo says yes, absolutely. If you're spending $5,000 to get a lead and you get $33,000 from that lead, and then they stay with you for 6 years or 6 months, 6x, you should absolutely spend the $5,000 because that's a good return on that customer. So that's why these metrics become important, right? Your lifetime value, your customer acquisition cost, your marketing ROI, you need to measure that. And then the last piece here, you need to measure your organic traffic growth. When you think about your organic traffic growth, it's really driven by your net promoter score, which we talked about earlier on. Your recommendations, people talking about your product, and then you start having customers come to you, which then drives down your customer acquisition cost, making you a much more profitable business and a super attractive business for investors. So organic traffic becomes important. So Damon, with what you're building, so Matt, with what you guys are building, you want to make sure that you have some type of way to really have excited customers that love you, that start talking about your tool and your application. Oh, absolutely. Asaf says you should segment the user that bring you free customers. Asaf, can you come in quickly and tell us what you mean by that?
There are a few type of user that more attractive to you as a company, that
Right.
you need to keep in touch with them and I don't know, reward them with a, I don't know, coupon or something like that.
Right. Absolutely. So you're going to have to then, from a sales and market, you're going to have to segment all of these different types of customers, right? Where they came from. Did they come from a conference? Did they come from Google ads? Did they come from Meta ads? Did they come from LinkedIn? Or did they just walk into your door through a recommendation? You're going to have to really understand all of those buckets of customers and how they're coming in. So you're absolutely correct on that. And then revenue model forecasting. Now, here's an example. Can you guys see my screen? Right? This is a model of how you want to build out your revenue modeling example. Okay. So you want to show it year over year. Now, most investors really care for the 3-year forecast. Some may ask for 5-year forecast, so you may want to have it available and ready to go. So you want to put that in your data room. So if you go and raise, you have a data room, put that in there. Okay, so you have that. It's all free stuff. Put that in your data room, so you have this forecast ready to go. When an investor then asks for this, you have it ready to just share, so you can see who's sharing with. When you're done sharing, you can just take the privilege away from them, then they can have access to it. Okay, so the data room is there for you and Raise to use that. But here's an example of your revenue model example. Okay, you want to show year 1, 2025. We start the year with how many customers? 0 customers, and we acquire 5 customers. Okay, and the average revenue for the customer is how much? $10,000. Of those, we lose 5, so we really total revenue comes down to $450,000 in the next year, because we lost 5 in the next year. In the next year, then you take a look at that. You started 45 because you lost 5, right? You lost 5, and then you acquire 70 new customers. You lose 10, so you're now up to 105. And now average revenue per customer is bumped up to 10,500. So you're now at $1 million in revenue. Then you go back the next year, you acquire 105 customers. You now have 105 customers total. New customers 100. You lose 20, you're now up to 185. Your revenue, average revenue per customer is now $11,000. You're now at $2 million in revenue. Is this a healthy business or what? A very healthy business. A very healthy business, right? This is showing you your hockey stick. Now, let me tell you what investors are looking for. You guys need to write this down. Every investor that's looking to invest in your business, they are looking for a return on their money. So there's a specific metric that they're looking for. Let me walk you through what the metric is, okay? You have to write this down to remember this. They are looking at 3x, 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 2x, 2x. 3x, 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 2x, 2x. Do you guys know what that means? Anybody in the group? Asaf says ROI. It does mean ROI. Anybody else with ideas what that means? 3x, 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 2x, 2x. I'll tell you what it means from an investor's perspective. If you're able to show that you're a 3x, 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 2x, 2x business, multiply of their money, their initial investment. Okay, that's shown. Let me tell you what it means. If you're able to show that type of growth in your revenue model, that means your business has potential to be worth $1 billion. You are a unicorn. They're looking for unicorns. Does your business have the potential to get to $1 billion valuation? So when they're looking at your revenue model, that's the first thing they're going to look for. When they look at the year-on-year growth, is it showing me 3x or is it showing me something else? Ideally, I want to see 3x, 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 then 2x, 2x. So I want you guys to look at your revenue models that you have today. I don't know what you have or don't have, or what you've built or not built. If you need help and support with this, send us an email and our team will schedule a meeting with you to help you with this stuff. Okay? We'll help you with this stuff. Now, when that happens, we'll walk you through the models and what you need to do to be able to get to those numbers, depending on your type of business. So there's some software business here in the group, in the chat, that are building software applications. Those have the potential to do that with subscription models. Marketplace businesses, the potential to do that. So if you need help with that, do not hesitate to reach out to our team and schedule a meeting. Send us an email at support@raisecap.com. We'll provide you the support you have. Send us your profile link so we know what you're building. If you don't send us, we don't know what you're building. We need to know what you're building first, right? To give you the help that you need. 100x eventually from 10,000 revenue, Asaf. Okay, 100x, that's good. Look at that. That's a good number. So let's go to the next thing here. This is Somath. What's your question, buddy?
Yeah, so my doubt is, so is this 3x, 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 2x, and 2x, is it like, so when they will check, it's on the year 6th year, they will check that, since for the first year, they can't check it. So post that, on year 2, they will check for 3x amount. Then on year 3, they will check for 3x amount. So like that on year 6, they will check on the 3x, 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 2x, and 2x. Is that so? It's the way that they check. I mean, that's how it is.
So here's, because right now all you're doing, you're building your model off assumptions. Okay.
Yes.
So you have to understand the market you're in. You have to understand who your potential buyer is and how they're going to buy and how much they're going to pay. Based on that information, you then create a financial model that you think is reasonable, that shows that type of growth. They're going to look at this at the beginning, not at year 6. Because by the time you
Okay.
get to year 6, you actually have real numbers. But right
Okay.
now, because you guys are pre-seed and seed, you don't have the numbers just yet. You're building your models off just assumptions, right? So if you're building it off assumptions, you want to show that, hey, in year 1, I think we're going to do 100 customers. And these 100 customers are going to give us $30,000. In year 2, we're going to have 200 customers. These 200 customers are going to get us to $90,000. In year 3, these 90,000 going to be $270,000. Do you see what I'm saying?
Yes.
These are all just based assumptions.
Yes. Absolutely. Thank you.
So you have to do, as Saf says, you have to do a lot of customer development stage important. The research around this is critical, guys. You have to understand. And again, our team can help you build these models. Okay? Just send us your race profile so you know you're on race profile. We look at your business, we'll schedule a meeting, and we'll help you with this.
Thank you. Yep.
Exactly. It happens outside the door, not in the office. That's good. I like that. Now, unit economics. We got a few more minutes here. Unit economics. All the stuff we just talked about really comes down to what's called unit economics. Do you understand your customer acquisition cost? Do you understand if you're actually going to break even and make money? How long is it going to take you to break even and make money on the business? That's what they're looking for, right? You can go. Jeff Bezos' business went for 64 straight months making a loss. I'm sure you guys know that. Amazon, 64 straight quarters making a loss. You do the math, how many years that is. But they knew exactly when their break-even point was coming. So you need to understand your unit economics. That means your customer acquisition cost. How much is it taking you to market these products? How much are you paying over time? What's your lifetime value on these customers? Are you making a profit? What's your gross margin? What is it not? If you have a software application, I'm going to tell you this right now. I'm going to give you this real quick. If you have a software application, your gross margins have to be north of 80%. If it's less than 80%, there's a problem in your business. Investors are not going to like it. Software applications have to be over 80%. Now, other types of businesses, you really have to look and understand your cost of goods to get to these numbers. These are very important to both the founder for you to understand your business, but also to the investors, okay? They're going to be looking at that. So your unit economics is absolutely critical for you to understand that. Your break-even analysis and contribution to modeling, okay? Here's a little bonus tip for you guys. Remember, some of the question was around, what if I have high growth in customers and also high churn?
Yes.
There you go. What does it say for you? It says, high churn limits growth regardless of customer acquisition. Because if you're bleeding the customers you're bringing on, it is very difficult to continue to grow the business. It's almost impossible. So you have to take a look at your pricing strategy. You have to take a look at your product, because all those things impact your revenue. And they also impact your 3x, 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 2x, 2x. Because if you're bleeding customers, that means you're not growing at the right rate. Because your coming back customers is adding to your growth rate to get to the 3x, 3x, 3x. ARR is a key metric for investor conversations. Annual recurring revenue. Every single year in your business, how much revenue are you doing? That's a key metric that all investors look for. So guys, this is your revenue modeling and your financial modeling. Get a grip of this, understand this. I know we didn't go into much depth, but we covered quite a bit of good content that you can take back and do some work on to really help build your business and prepare you for success. All right. Our next mastermind session, like I said again, is when? February 20th. It's on value proposition fundamentals. We'll be talking about compelling stories, how to bring customers on, how to have a strong value proposition. I've dropped the link in there. Please sign up. Again, if you find it valuable, you may not, and that's fine. Okay, this is all free for you guys. You may not find it valuable, but if you find it valuable, sign up, invite your friends, invite your people, have them join and be part of that. Our pitch competitions are coming up. This is all on our website. Check it out. If that's something that's of interest to you, sign up. Thank you guys, and see you on the other side, and happy fundraising.
Thank you, everyone. Thank you so much.
Thank you very much.
Thank you, sir. Thank you.